The US housing market in 2026 is not in a boom or a crash phase. It is in a reset phase, where high interest rates, shifting demand, and rising supply are slowly rebalancing the system. The biggest mistake most people make is assuming the market moves in a straight line. In reality, it moves in cycles shaped by credit, jobs, and inventory. Let's break down the key trends shaping the market right now. 1. Mortgage rates stay high, but volatile. One of the biggest forces in the housing market is mortgage rates. In 2026, rates are still elevated around the 6% plus range, with small ups and downs depending on inflation and bond yields. Recent market data shows borrowing costs remain the main barrier for buyers, keeping affordability tight even when home prices slow down. Here's the strategic insight. It's not just home prices that matter anymore. It's the monthly payment reality driven by interest rates. 2. Housing market is becoming more balanced. After years of extreme seller advantage, the market is slowly shifting toward balance. Inventory is increasing, and price growth is cooling. Forecasts for 2026 suggest home prices will rise only modestly, around 1 to 3% annually, instead of rapid jumps like in previous years. This means buyers gain slightly more negotiation power, sellers face more competition. Price wars are less common, but not gone. We are moving from a seller's market to a neutral market in many regions. 3. Inventory recovery is changing the game. One of the most important structural shifts is the gradual return of housing supply. More homes are coming onto the market as builders increase production and homeowners adjust to higher rates. This growing inventory is slowly reducing the extreme shortage that drove prices up in previous years. However, supply is still uneven. Some metro areas remain tight. Others, especially in the south and west, are seeing softening prices. This creates a two-speed housing market. 4. Regional divide is getting stronger. The US housing market is no longer moving as one unit. It is splitting into different regional behaviors. Expensive coastal cities remain high cost, but slower growth. Sunbelt areas see faster adjustments due to oversupply and migration shifts. Midwestern and smaller cities often show more stability. This means real estate success now depends heavily on location selection, not just national trends. 5. Affordability is slowly improving, but not solved. There is a small but important improvement happening. Incomes are rising slightly faster than home prices in some areas, and mortgage rates may gradually ease over time. But affordability is still a major challenge. Even with slower price growth, high borrowing costs keep monthly payments heavy for most buyers. So the market is not becoming cheap. It is becoming less overheated, not affordable. 6. Buyer behavior is changing. Because of high rates and uncertainty, buyers are becoming more selective and strategic, waiting longer before purchasing, negotiating harder on price and repairs, focusing more on monthly payment than listing price. Sellers, on the other hand, are adjusting expectations and offering concessions more often. Strategic conclusion. The US housing market in 2026 is defined by one core theme: rebalancing without a crash. Rates remain high, keeps pressure on buyers, inventory is rising, reduces extreme competition, price growth is slowing, market normalization, regional differences are widening. Strategy matters more than ever. This is not a market for emotional decisions. It is a market for precision timing and location-based strategy.